Hey everybody, this is Brent from Wolf on Wall Street Trade with a market update for the week ending July 2nd, 2020. It was a holiday shortened week, so this will be a holiday shortened video. So here's the 4 days of the week. We're off Friday. As of last week, the S&P was set to come down about 2% more on a measured move. And what I mean by that is we had this first leg here, a little consolidation the week before, a little bearish consolidation. So we were set to come into the week. We ended over here, set to come into the week with about another 2% of downside, just measured move right here. But the problem with that is that at that point, the S&P would have to go under 200-day, which it actually closed a little bit below that prior Friday, and this 50-day. So there's a lot of technical support there, and a 2% move didn't look like a really high probability with all this support in the area. Instead, we got to bounce off that. Volatility just got crushed this week. VIX on the week down 20%, and we had a lot of things going on. Jerome Powell, the head of the Fed, and Mnuchin, the head of the Treasury, were both set to testify before Congress on the CARES Act. We had the FOMC minutes coming out. We had payrolls report, a whole bunch of stuff going on. So as you can see on Monday, just bounced off this 200-day moving average. So that's the second time this 200-day has been tested in 2 weeks. Notice that the island top right over here that started from the prior month's payrolls is still open over here. So the S&P hasn't filled that gap. On a 15-minute chart, you can see that island top right here. So here's what we did this week. Just kind of ran into resistance again right at this former kind of consolidation zone. Here's a closer look at the week on a 5-minute chart. So this is Thursday when payrolls came out. So the S&P did get above this consolidation zone, dropped back below it, kind of found resistance there and closed down. This was actually a pretty ugly day on Thursday after the payrolls report, similar to last month's payrolls report where the day started really strong. Right over here, the day started really strong and we saw the bond market, a whole bunch of things change really fast. They led the S&P lower and the S&P kind of caught down about 3 days later. So this payrolls report over here was very similar in tone to this one, not quite as extreme, how fast, tone changed intraday from positive to more negative, but similar. The S&P gained 4% on the week. This is a daily chart. So if you zoom in, you can see it started losing some momentum right before the payrolls report on Wednesday. And then Thursday, here's kind of a bearish, almost a shooting star. That's that reversal on Thursday I was talking about. The tone changed. So 4%, the equal weighted index underperformed by about 85 basis points. Not a lot of stocks are driving the market. It's just 5 or 6 really heavily weighted mega caps. And on a longer perspective here, we have this broadening top. And if we zoom in a little bit closer, you can see that that's still a factor here. So Friday just moved a little bit above it and then came back down. There's the island top over here. But this is that trend line from the big broadening top that's been in effect really since the beginning of 2018. The NASDAQ 100 was the best performing. It made a new record high here on Wednesday and again on Thursday. You can see the momentum changing with this it's kind of like a big star, but new highs anyway. And again, the equal weight index of the NASDAQ 100 underperformed the NASDAQ 100 by about 85 basis points, the same as the S&P, but the NASDAQ 100 gained 5% on the week. I talked about this in last week's video because we saw, a new high over here in the NASDAQ 100, another new high. This week we had another new high here, another new high here. But if you look at the equal weighted index, you take out that heavy weight from those FANG stocks, 4 or 5 stocks, you can see that the equal weighted index did not make new highs over here, did not make new highs until Friday over here. Finally made a new high, only less than 0.1% above the new high over here. So NASDAQ 100 has been making new highs over here, new highs over here. The equal weighted index finally just made one, and by less than 0.1%. But one other thing on NASDAQ, I'm going to back this chart up 1 day to Wednesday when it made this new high on Wednesday, up 1.21%. NASDAQ is very tech heavy. So what I'm getting at is that only a few stocks drove the NASDAQ. So if we look at the technology sector, check it out on that day. It was up less than 0.2%. And semiconductors, right? They usually lead the NASDAQ. They were down 1.5%. What does that mean? It means that 4 or 5 very heavily weighted mega cap stocks are driving the entire gain. And that's not just for the NASDAQ, but it applies to the S&P and to a lesser extent the Dow, because the Dow does have some of those components. Speaking of the Dow, it was up 3.25%, bounced off its 50-day moving average, and here's its 200-day moving average. So you can see resistance there at the 200-day. It's had a problem there. Here's the island top in the Dow, just like the S&P 500. Kind of a little bit of a bearish candle on Wednesday. And again, on Thursday, when we had the payrolls report, open strong, did not cross above that 200-day, and comes down with something almost like a little shooting star. It's just a bearish change in character on Thursday. And small caps up about 4.2% on the week. And you can see, again, Wednesday, bearish change in character with a dark cloud cover. And again on Thursday. And there's the 200-day moving average. They seem to be struggling at this zone of overhead supply that I've pointed out before. Take a closer look over here. There's the week. And also right around this decade-long trend. Okay, that defines the bull market for small caps. Broke down below it. Briefly got above it, and now it's been kind of bumping up against that from below, or back testing. Here is the VIX, down 20% on the week, broke below the 50-day moving average, held the 200-day, and you can see the change in character on Friday with this little bullish hammer. So that's right at the 200-day where it found support over here in June. And on a 60-minute chart, last weekend's video, I was talking about the change in character that we broke out of this channel. So although it was bad for VIX this week, it's still kind of at where it broke out on this channel, down 20% on the week. It really did come under a lot of pressure, and I think that is something you just have to expect anytime the Fed is involved. If there's a Fed event, FOMC meeting, minutes, or Powell speaking, it's like the New York Fed's open market desk goes and just sells volatility, so the Fed chairman won't be embarrassed by a market sell-off while he's speaking. As far as S&P sector performance, and remember this week was the end of the month and the end of the quarter, so kind of expecting some rotation, maybe some window dressing. Definitely got the markup aspect of it, but I really didn't see much of that. As a matter of fact, if you look at the best performing sectors and the worst performing sectors, there's just no theme. So one of the best performing was materials, and this is a 15-minute chart of materials. So here it is on the week, up 5.6%. It was one of the few sectors that kind of did pretty well, technically speaking. So it's a cyclical sector. It was one of the best performing. From a technical aspect, it got back above this 200-day. So that was one of the few sectors that had some kind of change as far as like the technicals go. It looks like it found a little bit of resistance around this gap. It's a cyclical sector. The other sectors that were top performing were communications, which is filled with mega caps, and the other one was real estate, which is a defensive sector. So that didn't make a lot of sense. And then the worst performing included cyclical sectors like energy, financials, and banks. Speaking of energy, here it is, up 2.25% on the week. So it's green, but it was about half of what the S&P did. Here's that bearish triangle that break down the prior week. It did have some support here. So this is just kind of like a little flag. It's really nothing, technically insignificant. Didn't change the outlook here. And on the daily chart with the 50-day moving average, didn't change the outlook there. You can see it looks like a little flag under the 50-day moving average. The financial sector was another laggard, up 1.7% on the week, so it was green. But as you can see, again, like energy, the week looks like a small flag. And on the daily chart with the 50-day moving average here, it's just hovering right around that 50-day moving average. Banks, which are in the financial sector, were horrible this week. They were up less than 1%. You can see a bearish descending triangle over here, broke down the week prior. So this week was just a consolidation. It was green on the week, but in this flag, zoom in a little bit closer, you can see. And Friday was really ugly. Thursday was really ugly. Opened up strong. Opened up real strong and then just collapsed the rest of the day. And on the daily chart, very similar to financials with this 50-day moving average, just hanging around it. I've still got my short in Wells Fargo, WFC, and it was 0% on the week. Didn't move at all. And this 50-day moving average below it. Technology underperformed the NASDAQ. It was up 3.7%. NASDAQ was up 5%. So it underperformed, but the point is it's still holding this trend line from the March low. And this is the most heavily weighted, most influential sector, but it's really starting to underperform now as well. And the NASDAQ is really, actually the whole market is really deriving all of its gains from like 4 or 5 stocks. Those are those mega cap fangs. Okay, so what you're looking at is the NASDAQ 100. Here's its new high. This is a daily chart. Now I'm going to add an equal weight index of FANG components. And this chart just speaks for itself. You can see what's going on here. 4, 5, 6 stocks are dragging the entire market, especially the NASDAQ, more so the NASDAQ, higher. But at the same time, it's masking weakness. This is the NASDAQ 100. And what I'm going to do is put on an indicator that shows how many of the NASDAQ 100 stocks are above their 50-day moving average. As the market was rallying early on off the crash low, you can see most of the NASDAQ stocks were participating. As we get into June, you can see what's happening. Fewer and fewer and fewer stocks, each time the NASDAQ makes a new high, are participating. Fewer stocks are participating. That's weak breadth. Now, that can go on for a while, but it makes for a really fragile market. We saw the same thing over here in January, February before the market crashed. And that had not happened before. You know, we had solid breadth on the way up, had solid breadth over here on the way up. So that is illustrating how much 4 or 5 stocks are driving the entire market, while the majority are not doing so well. So if we come in closer, you can see new high here, new high, over here, new high over here. But what's happening over here is lower highs, fewer and fewer stocks participating in this rally. The bond market, this is the 10-year yield on a 60-minute chart. The bond market did not buy the bounce at all. So the 10-year yield was up like 3 basis points on the week. If it were just keeping pace with the S&P, it should have been up probably like 10 basis points. Here's that channel I was talking about. It broke below that. We've got, since the last payrolls report right here, we have lower highs, right, and lower lows. Did not do anything technically to alter the picture of this kind of declining sentiment coming from the bond market. Here's the 5-year yield. It was completely flat on the week, so it didn't move at all. It didn't move higher, which is what you'd expect to see in a stock market rally. And again, it had broken this trend and it just back tested it. The message from the bond market was mirrored in the yield curve. So this is the NASDAQ 100 in red and green candlesticks, and this is the 5-year, 30-year yield spread. So this is the last payrolls report, and this is that really sharp change in character I was talking about on that payrolls report. So curve steepened a little bit, but we still have this trend of lower highs and lower lows. A lot of times the yield curve will change shape. It will start to flatten like this. The banks are the ones that are most sensitive to this, and they react first. So let me clean this up real quick. So here's the NASDAQ ignoring this flattening yield curve since the last payrolls report. Now watch when I change this to the regional banks. They get it. They're following the yield curve. They see the signal that the bond market's sending. Again, here it is, last payrolls report. Changed real quick that day on the 5th over here. When I say I'm looking for a market signal, not just technical stuff, but I'm looking for a market signal for a high probability trade, this is one of the things I'm looking at. The bond market, the yield curve. So this was one of the signals that we got. Let me change this to the S&P real quick. So this is one of the signals we got last payrolls, a really sharp flattening really fast, and then the S&P followed. First the banks, then small caps, and the S&P. They all followed it. So that's one of the signals I'm looking for. So if I saw something like a really sharp drop like this, that would be a market signal. It could come from the bond market, it could come from the currency market, come from commodities, it could come from S&P sectors. Speaking of commodities, gold did something big this week. It broke out above 1,800. So here it is, broke out above 1,800 on Tuesday, fell back down below, but it was a really strong, really sharp breakout. Let me go to GLD. I just like drawing on that chart better. So it had been consolidating over here. Here's the breakout. Here it is on a 60-minute chart, and let me get a little closer. So last weekend in the video, I said I bought an asset related to gold on a pullback. This was the pullback right here. So this is this week over here. So it still did well, still closed higher. But I said I bought it. It wasn't gold. It was gold miners. So GLD ended about 0.25% higher on the week. Here is GDX. It was coming out of this big bull flag, had made another small bull flag when gold pulled back. So did it right here. That's exactly where I bought it. And if you bought the calls the same time I bought them, they were up about 55% this week. But the point is, it was a really nice move, and gold miners broke out with gold over here on Tuesday. This is a bullish looking chart. I like it, but you can see we do have some resistance right over here. The targets that I laid out earlier in the week for gold and gold miners, they're unchanged, so I'm still long gold miners. So heading into next week, you can see we're starting to get this kind of sideways zone from June. This is why I'm looking for market signals. We do have this island top still in effect and kind of this range right in here. And for the Dow, it's pretty well defined at 200-day moving average kind of marks where this island top is in effect. But then we have support right below the 50-day moving average. Now we are coming into earnings season in just under 2 weeks. What happened last time we went into earnings season? Well, the market rallied into it, but then went sideways. So here's a 30-minute chart of the Dow, rallied into earnings. Earnings started right about here, went sideways, broadening formation. This is that strong period into payrolls, and then payrolls is right about there, and that's when things kind of reversed. But my point is, into earnings season, the market just kind of went sideways and wanted to see what was going on. This is another one of the reasons that I'm looking for strong market signals, because to break, either above this gap where we have island top over here or below those moving averages, which are providing strong technical support, I want to see a really clear, really strong signal. On 3C for the week, this is the SPY. So this is the last time we got a pretty good signal, that Tuesday, and came down. So this is this past week. Really not a lot happening most of the week, kind of fizzling out a little bit as we got towards the end of the week. And then Friday, this kind of decline over here looked pretty bad on 3C. So you can see it's kind of leading negative. We'll see if that holds up into next week. IWM, here's where we got that signal. It was really strong in NASDAQ more than any other place. But again, this week, really not a lot going on. We're seeing confirmation early in the week over here, but then we're kind of just flattening out. So not a lot of great confirmation. You can see that open on Thursday morning just get dumped with the banks. And here is QQQ. Here's that really sharp signal that won Tuesday, almost 2 weeks ago or so. So here's this week. Again, not great confirmation into the end of the week. And then we could just see it kind of coming apart over here on Wednesday. Not great confirmation. And then again on Thursday into the close, kind of getting a little bit of a leading negative signal there. It's a bigger divergence than this one. It's not quite as sharp. But because volatility has just been crushed, it's really helped out and benefited the market. It's kept the market calm, and it's supported the market. So if we start to see volatility firm up, then I would be a lot more worried about this divergence. Another thing I mentioned early in the week was credit was looking really bad, which is strange because the Fed is backstopping credit, high yield junk credit. This is the S&P 500 in the candlesticks, and this is an equal weight index of about 4 or 5 different high yield and leveraged loan assets. Okay, so they're all just put into one equal weight index. This is the island top for the S&P. This is the last payrolls report. So if we kind of draw like a range here, and we just define the S&P, S&P's 200-day is over here. Here's kind of the top of the range, right? And then you look at where credit was at the top of the range over here, and look where it is now over here. So it's acting real bad. It was negatively divergent right there. It's negatively divergent again right here. So that is something, it did bounce on the week, but it's looking really weak. And again, it's surprising because the Fed is backstopping high yield credit and corporate credit. One other interesting thing to mention real quick, saw this at the end of the quarter, last trading day of the quarter. This is the CBOE Skew Index, or the Black Swan Index. So you get, above 135, 140. You're getting into some areas where there's like major hedging of tail risk. So the last time we saw a pretty high level was right here before the crash in February. Look where we are this week. I mean, just blown above this level over here in February. And let me show you what I mean. So what I did was added the S&P in green over here. So the last time the skew was this elevated was just a couple days before this crash started in the S&P. And the skew right now is way higher than it was over here. It's into what are, historically nosebleed levels. It's sending a signal that professionals are hedging tail risk, which is like black swan risk, unexpected risk. So this could fall into the bucket of a market signal. Some of the other ones, USD/JPY is one of the ones that I'm looking at. So we got a real strong market signal right over here. This is payrolls, right into payrolls. This led the market down by about 3 days. We got another one here. I said if it breaks this trend line, that's going to be a market signal. This led the market down by, I think, 1 day. And we did get a little bit of a dip over here on Wednesday. So, if I saw it break this trend line below 107, that would be another market signal. The 10-year yield, like I said before, it is making lower highs and lower lows. So if I saw this turn down and break below, say, 0.62, 0.6 over in this area, that would be another signal. So if it breaks down even more sharply, that would be a stronger signal. Now, conversely, if it rallied up strongly like it did over here, that was a sign of strength. It just didn't last very long. Also coming in July, the extra $600 for unemployment, that runs out at the end of the month. And after the jobs report, a lot of the Republicans were saying that it didn't seem very likely that they would keep that or extend that. And a lot of the stimulus measures that they were talking about seem to be less likely. COVID cases are another one. Of course, I'm here in Florida. This is our new reported cases. I pointed this out, when it was back here, it wasn't even above this level. So it's gone basically parabolic since then. The death rate lags, and I hope it doesn't pick up, but it does look like it's picking up here in Florida if you look at this weekly moving average. And every weekend before I do these videos, I run through about 320 different Morningstar groups. And some of the ones that I'm seeing recently look like they are paying attention to what's going on here with these rising COVID cases. And by the way, The payrolls report that just came out that smoked, expectations, it was much better than expected. That was gathered right here in June. This was the week it was gathered. So that was before we started seeing all these new cases. This is United States new cases rising. So without going into too much detail, most of these sectors will look a lot like the S&P 500. And this is the 50-day moving average, the 200-day in blue. Just keep an eye on the 50-day because that's just kind of what I'm using to say, look where the S&P is above it, and let's look at these other sectors. Now, some sectors look really good still. This is one of them, diagnostic substances. So stuff for testing coronavirus, for instance, or application software, something like Zoom. But many others that I would think would start to deteriorate if COVID cases picked up and the market was worried about that are starting to look bad. So just watch them relative to the 50-day moving average. Here's shipping. Okay, this is the whole sector, not just one stock. So below the 50-day moving average. Oil and gas refining and marketing. Aerospace and defense. Movie production theaters. Resorts and casinos. REITs, hotel and motel. The leisure group. So this includes restaurants. It includes gaming, casinos, general entertainment, department stores. Again, all trading below this 50-day moving average or back testing into it. And of course, the regional banks, which I've mentioned before. All right, well, with that, I think I'm going to wrap it up. As far as the whole idea of this still being a counter trend rally, I think it's still very likely. So let me pull up the Dow real quick here. A rally is counter trend until it makes a new higher high. So this is still a counter trend rally. And I always say they're the strongest rallies you'll ever see. So off the low to the high, not to where we are now, about 48% for the Dow in about 3 months, right? And the example I've used over and over again, because it's one of the most extreme counter trend rallies I've ever seen, is the Dow back here in 1929. So it had this crash, it had this rally over 5 months, one of the sharpest bear market rallies ever. Just over 47% in 5 months, this bear market rally. And then, it turned down and lost over 90%. So here it is in retrospect. That's the counter trend rally, 47, 48%. Pretty much what we have right now. And there we are now. So that will do it. Thanks everybody for listening. If you enjoyed the video, please give it a thumbs up. Always appreciate that. And the comments, questions, I try to get to as many as I can, and I learn a lot of stuff. So I appreciate those. You can follow me on Twitter. I have a link below in the video description, and you can check out the website. We do have some occasional free posts. You can sign up for those or check out being a member. So that will do it for this weekend. Everybody have a fantastic 4th of July. Members, if anything comes up Sunday night, I'll have a brief out. Otherwise, I will see you Monday morning. Thanks, everybody.